Hello everyone, welcome back to our weekly webinar series. My name is Faiza Hashmi, I'm the tax director here at Quest Cooper. We have been conducting this weekly webinar since the corporate tax has come out, and we have covered a lot of topics since then. You can find these topics in our YouTube channel if you have missed any of our weekly series. Mahar, can you change the slide? Covered, you will see that we have discussed. So if you guys have missed any of these topics, they are available at our YouTube channel. Can you switch the slide? So the topic for today for us is the transfer pricing guide. Like I already mentioned, that a lot of information is flowing from the authority. A lot of cabinet decisions have recently come out as well, and the FTA is ensuring that everybody's up to date with all the topics. So now they've recently taken out on October 23rd this transfer pricing guide to give you more information about the provisions of transfer pricing. So that is the topic that we will be discussing today. And I will be joined by Mahar, who will be taking you also through this topic. He is the managing director here at Quest Cooper. So just to give you a little background, so why do you think there needs to be transfer pricing rules? Why is there a need for transfer pricing rules? So transfer pricing rules have been existing in the other jurisdiction where there's corporate tax. And why is there a need of this? Because there are a lot of companies that are doing transactions with their related have those transaction monitoring to ensure that there is no profit shifting from high jurisdiction to low jurisdiction. These transfer pricing rules have come out and they are there in place for these kind of transactions which are being done with any of your related parties or with connected persons. So just to give you like an example, we'll take one example that A Limited is incorporated in UK. UK, there is a corporate tax rate of 19%. And B Limited is a company which is incorporated in UAE, where right now the corporate tax rate is 9%. So we can, let's say that UAE company has given the UK company a loan for 20 million and at a higher interest rate, let's say 10%, as opposed to what is in the market, which is 5%. Mark, can you show the slide? Yeah. So now if you look at this illustration, there's a control transaction and an arm length transaction. So in the control transaction is what will happen if there were no transfer pricing rules. So if you look at that, so in A Limited has the profit before tax of interest and tax of 5,000, and the interest right now, since they have given it at a higher rate, is 2 million. So on that profit before tax, 19% tax rate would be applicable, and the tax amount would amount to 5,70,000. And similarly, for B Limited, you can see that the tax rate is 9%. So the tax that is coming amounting on the profit before tax is 1,080,000. Now, if you look at the arm's length transaction, which if this transaction was not with a related party and it was given at the correct market, the interest was given at the correct interest rate. So then you can see that the tax amount here, after if you apply, if you take out the correct interest expense on this rate, would be 1,000, which would be leading to the tax amount to be 760, which is a lot more than what it was in the control transaction, which was 570. And then for B Limited, the tax amount would be 990. So if you see the consolidated results, that they would be paying more if they were doing an arm length transaction which is 1,750,000. But in case of the control transaction where they're giving the benefit to the related party, it is coming out to be 1,650,000. So to avoid this situation, to ensure that this is not happening between related parties, these transfer pricing rules have come in place. Can you shift the slide? So just talking about the illustration, like I just said, so it is evident that in the control transaction, the interest expense is being overbooked by 1 million. And as compared to the fair market rate, right? So this has eroded the profit from 1 million from the high jurisdiction to the low jurisdiction, since UK tax rate is much higher than the UAE tax rate, like I discussed before. So now this has helped the company to avoid around 100,000 taxes, which they would be giving more, like we saw in the illustration before, if they were doing this transaction at an arm's length price. So this is basically the concept behind these rules, to ensure that if a company is doing a transaction with a third party or a related party, the same effect is coming, and there is no manipulation happening, and no artificial manipulation of pricing is being happening, or redistribution of profit is being happening from one company which has a higher tax bracket to a company which has a lower tax bracket, or you can say from a higher jurisdiction to a lower jurisdiction. So I'll give it over to Mahar now, who will take you to the rest of the slides.
Thank you very much, Faiza. Really appreciate it. Thank you very much. And yeah, I think you all have gone through this example, and as Faiza has mentioned that in the control transaction, the tax amount was 1,650, and in the uncontrolled arm's length transaction, tax amount was 1,750. What was the reason of this? And the reason of this was the UAE entity has given a loan of 20 million dirham to the UK entity at 10% instead of 5%, which was the market rate. When the UAE entity is giving loan at 10% to the UK entity, it means UAE entity is helping UK entity to increase the cost, to increase the interest rate. So this is the reason at the arm length, interest expense was 1 million for the UK company, but whenever they have manipulated the transaction, the interest amount has gone up to 2 million. So means UAE company has helped the UK company to increase the cost and to reduce the tax base. So once the cost has gone up from 1 million to 2 million, the taxable profits has come down. When initially the taxable profit of the UK company was 4 million, due to this loan at the higher interest rate, the taxable profit has come down to 3 million. And due to this, since the taxable profit has come down to 3 million due to the higher interest rate loan, they are paying lesser tax. Initially at the arm length, the tax amount would have been 760,000, but when this loan has been transferred at the higher interest rate, the tax amount has come down to 570 million. If we're looking at the group level, overall group has saved tax by controlling this transaction. What was the reason of control? Basically, UAE entity has helped the UK entity to reduce their taxable profits. Once their taxable profits has come down, ultimately their tax amount has come down. So these are the numbers given has been the FATF. FATF says annually $240 billion there is a tax revenue loss. And this is not my number. These are the numbers given by the FATF. $240 billion annual tax revenue loss. So this is the reason, just due to control this transaction, they are bringing the transfer pricing regulations, transfer pricing guidelines, Organization of Economic Cooperation and Development, World Bank, FATF. They were all working together on this assignment, and they brought some guidelines for the transfer pricing. And the member countries of FATF globally, they are adopting the transfer pricing rules and regulations. UAE is a member of FATF, and UAE is applying the transfer pricing rules and regulations. Now, the legal requirement in the UAE law, the legal requirement is that all transaction with the related parties and all the transaction with the connected person must be at the arm length principle. So two things here are very important. One is the related party, transaction with the related party. Second is transaction with the connected person. It should be at arm length. We need to look into the definition of what is the related party, what are the connected person, both of the parties. And whenever they are doing any transaction, it should be on the arm length principle. And these arm length principle based upon the OECD, Organization for Economic Cooperation and Development, they have issued transfer pricing guidelines, and these arm length principle based upon the OECD guidelines. So what is the arm length principle? The simple rule I'll say, what is arm length price? Arm length price is the price at which one party is selling goods and services to third party at the same price. They need to sell these goods, these services to the related party or to the connected person as well. This is the arm length price. Means nobody is manipulating the transaction, nobody is controlling the transaction market prices are being decided by the free market forces, demand and supply factor, whatever the factor prevailing into the market. Nobody is controlling the transaction. So how can we identify the arm length price, arm length principle? What is arm length principle? Arm length principle, this is the 4-stage process given in the guide as well. First of all, identify the related parties, connected person, relevant transaction. This is the first stage. Identify related party, connected person, related transaction and arrangement. Then we need to do the comparability analysis. And after this, we need to apply the TP method, the 5 TP method. We need to select out of this one. In case any one of the 5 is not suitable, law allows us, it has been given in the guide as well. Then we can apply any other recommended method. Then at the end, we need to set the arm length price. This price would be helpful for the free and fair market value transaction. The first question is application of the rule. These rules, TP guide is applicable on the related party. These TP rules and TP guide is applicable to the connected person. This is not, we cannot say these are only applicable to the related party. No, these are applicable on both of the parties, related parties and connected person. And a very important thing might be this related party, might be this connected person, or in the UAE somewhere, might be out of the UAE. Means TP rules, TP regulations are applicable on the local domestic transaction, on the cross-border transactions as well. A lot of people have confusion. They're asking, TP rule will not be applicable under domestic transaction. It has been very categorically given in the guide. TP rules will be applicable on the domestic transactions as well as these will be applicable on the cross-border transactions as well. Condition is the transaction is being made with the related party or with the connected persons. This is the related party. These related party definition has been given in the law. They said partner in the same unincorporated partnership. Partner in the partnership will be considered related party. Natural person having a 4th degree of kinship. 4th degree of kinship means siblings, parents, uncles, cousins, in between the cousins. So this is the basically transaction in between the cousins, starting from sibling and parents till the in between the cousins is the 4th degree of kinship. The natural person and juridical person, where natural person is owner more than 50% or shareholder control along with the related party. So natural person, these all definitions has been given like trustee, founder, settler, beneficiary of the trust, person and its PE. They will be considered related party. Person where the juridical person is holding more than 50%, a juridical person is the owner, these will be considered related party. So these are the parties where TP rules and TP regulations will be applicable, and in case this transaction is being made with them, the law says the price that has been decided with them, it should be an arm length price. So related party, repeating partners, natural person having a 4th degree kinship, natural person and juridical person, where the natural person they are owner more than 50% and control more than 50% are juridical persons. 2 juridical person can be related party as well. 1 natural person, other juridical person can be related party as well. Natural person can be related party. Partner in the same partnership can be related party. Person and PE can be related party. Trustee, founder, settler, beneficiary of the trust, it can be related party as well. So rules will be applicable on all these related parties. Then the law says it will be applicable on the connected persons as well. The definition of the law which has been given in the UAE law, the definition, this is owner of the taxable person or officers or owner, it will be considered connected person. So in this connected person, owner will be a connected person for the business. Related party or officer will be connected person. Director, officer of the taxable person will be considered connected person. So TP rules are applicable on the connected persons as well. And these connected persons, I'm just repeating, owners, related party of the owner or officer, and owner officer by itself. So if Mr. A is a CEO, Mr. A is holding more than 50% in any company, this company, and where the Mr. A is a CEO will be considered related party, because law says related party and officer. This is the officer, this is the related party of the officer. These two entities will become related party as well. So we need to be careful while deciding which parties are related parties, which are the connected person, where the rules will be applicable. Then in the guide, they are saying the way definition in the law, they have repeated that these definitions of related party, connected party, as given in the article 35 and 36 of the law that we have just discussed. Then this is the comparability analysis. This is the second stage. We have identified, first of all, we said to apply the arm's length principle, we need to identify the related party. We need to identify the connected person. We need to identify the arrangements. We need to identify the transactions. Once we have identified this, then we need to apply the comparability analysis. What is comparability analysis? Comparability analysis means to compare the controlled transactions with the uncontrolled transaction under the similar situation, under the similar circumstances. So once we are comparing this controlled transaction with the uncontrolled transaction, this is called comparability analysis. And comparables, it can be our internal comparables, it can be external comparables. While comparing this transaction, we'll have a discussion in detail when we'll have webinar on the related comparability. We will have one specific webinar on the comparability analysis. Then we all discuss. For the time being, you can keep in mind that this is the arrangement. This comparability analysis is basically comparing the controlled transaction with the uncontrolled transaction under the similar circumstances. And these comparables can be internal comparables, or it can be external comparables as well. Then the third stage was what we need to identify the TP methods, and we need to apply a TP method based upon the findings of the comparability analysis. Based upon the findings of the comparability analysis, we need to apply the TP method. There are 5 TP methods which has been given in the OECD guideline and in the UAE corporate tax guide as well. So these 5 methods is the transaction. Out of these 5 methods, 3 are traditional methods. This is the one traditional method, second, third. These 3 called traditional methods. Out of the comparable uncontrolled price method, resale price method, cost plus method. We will have a separate webinar, I believe, on each method, where we'll take the examples as well. What is the comparable uncontrolled price? What is resale price? What is the cost plus method? At the high level, I can say that this method is applicable where we are dealing with the commodity. This is applicable where this reselling or trading. This method is applicable where the semi-finished goods are being transferred from one person to the other related party. These transactional net margin method, these are the methods where there's a high level of integration, and every party is performing separate and identifiable unique role based upon their assets used, based upon their function, based upon the risk taken by them. Every party needs to share the profit, needs to charge the price. There are 2 methods for this transactional net margin method, and the next one is profit split method. So these are the 5 methods which has been given in the OECD guidelines, and the same 5 method has been reproduced in the TP guide issued by the FTA. Moreover, they said in case taxable person believe that there's any other method we can give more justifiable price for the transfer pricing, then they can adopt those methods as well. Again, as I mentioned, we'll look into these methods in detail in our coming webinars. Documentation requirement is there. Once the taxable person is required to maintain specific documents, and these documents are TP disclosure form. This disclosure form, the taxable person needs to maintain annually, and at the time of submission of the return, annually at the time of submission of return, they need to submit this form to the FTA as well. They need to maintain the master file, they need to maintain the local file, and they need to maintain the country by country report as well. There are certain conditions which taxable persons are required to maintain the CBCR file and which are not. We need to look into this, and this specific criteria, as I mentioned here, The taxable person shall maintain master file and local file if any of the conditions are fulfilled. These conditions where the taxable person is part of the MNE group, multinational enterprise group. One entity is in UAE, one entity is UAE, one entity is in KSA. The company has become a multinational. If one person is a part of the multinational and the revenue is overall 3.15 billion annually, then they need to maintain the master file and they need to maintain the local file as well. Law further says or. This is important. This is not and, this is or. One or B, any of these two conditions are being fulfilled. The second condition is taxable person revenue is more than, or taxable person revenue is dirham 200 million or more during a tax period. So either A, either B. Out of these two, if any of these two, one condition is being satisfied, then the taxable person will be liable to maintain the master file. They will be liable to maintain the local file. In the master file, usually what is in the master file? This is the high level overview of the business, high level of the transaction. This is in detail of the transaction. CBCR is the country by country reporting. There are certain specific rule for the CBCR reporting as well. We'll be looking into this once. We'll be having a separate webinar on the transfer pricing documentation. This is a master file. Master file, usually, as I mentioned, this is a high-level organizational structure, description of business, M&A intangibles, intercompany transaction, financial and tax positions. These are documentation required for the local file. This is a specific detail about the transaction, specific entity, financial information about the local business. So master file tells us the high-level overview of the business, strategy, markets, organogram, high level. Then this local file will provide a detail about the local entity, transactions, more detail about the transaction, CBC reporting there as well. Then in the guide, the same thing has been highlighted. Just wanted to highlight the same thing has been highlighted in the TP guide as well, which has been issued by the FTA. We'll go through the guide very quickly after these slides. Then in the TP guide, they have given specifically the certain treatment for the very common transaction into the market. These common transactions are treasury functions like intra-group loans. They're very common that the corporate company, the corporate group is taking loan from the bank. Then after negotiating with the bank, taking loan, then the corporate entity, the corporate office is giving a loan to the subsidiaries. Then it means once the corporate entity is taking loan from the bank, this is the corporate entity, there are multiple subsidiaries under it. This entity is taking loan from the bank. If this entity is taking loan from the bank, this entity, then giving loan to subsidiary, they need to charge the arm's length price. They need to charge the arm's length price. Even this is a part of the tax group. There are certain conditions. If those conditions are being met, they are not liable to charge even if they are part of the tax group. If they're not part of the tax group, then for sure they need to charge the intra-group transactions. Sorry, so the transaction between the group entity as well, if they're not part of the tax group. If they're part of the tax group, okay, upon certain condition, they are not liable to charge the TP rules. The TP rules will not be applicable. The intra-group transaction, very common. Intangibles is very common. The intangibles are developed centrally, then charged to other entity, cost contribution arrangement, business restructuring, permanent establishment, business synergy. These all are the specific cases which has been given in the guide, which has been published by the FTA. We'll discuss this in our coming webinars in detail. So if I'm going through the guide very quickly, allow me to go through the guide quickly. Okay, hope everybody can see this. This is a guide which has been published by the FTA, as Ms. Faiza has mentioned, has been published in, I think, in the last week of October. So in this guide, if you look contents, first of all, a glossary introduction, then transfer pricing at a glance, application of the arm length principle that were discussed, 5 stages application of the arm length principle. They have given the high level understanding of why transfer pricing is important. This transfer pricing important. We have already discussed one example, the why transfer pricing is important, because whenever the parties, related parties are controlling the transaction, they are shifting the profit from the high tax jurisdiction to the low tax jurisdiction, from the high tax entity to the low tax entity. So this is the reason that the transfer pricing transfer pricing rules and regulation has been introduced. Arm and principle, identify the related parties, selection of the method, determination of arm length price that we discuss. TP documentation, again, they have given in detail specific considerations. These specific considerations are financial transaction, as I mentioned, intercompany loan, treasury, centralized treasury function, cash pooling, hedging. All these functions will be, then it will be subject to transfer pricing rules and regulation if the transactions are being executed with the related parties. Then intra-group services are there, intangibles, cost, contribution, allocation. If you will go through all these, this is a definition. Okay, these are the definitions, and this is the introduction where TP is important. Then status of the guide. Transfer pricing at a glance, they give an overview, transfer pricing principles and fundamental. What is TP? What is transfer price? We have already discussed through the loan example. Arm length principle means the need to charge the market price at a very fair value. Then they have given one more example as well. I think this is a similar example that we have already discussed. Then scope of the transfer pricing rules, this is applicable on the related party. This is related party. Then we discuss the 6 different types of related party. Out of this is one is fourth degree of kinship. They have defined the kinship. They define the definition of kinship affiliation, cover the relationship of between 2 or more individuals. These 2 or more individuals discuss fourth degree of kinship, and fourth degree of kinship as discussed in between siblings and parents is the first degree of kinship. Then with the uncle, second degree of kinship, between the cousins, third degree of kinship. Then there's a fourth degree of kinship. They have given the example for the fourth degree of kinship. This is a definition as per they have taken from the UAE corporate tax law. They have defined the ownership in DTC, basically straightforward related party. They have given in detail what is the related party, what is the connected persons. So this is they have given the in detail connected person as we discussed. It can be owners, officers, or related party of the officer. Then they said application of arm length principle. This is 5-stage process, 3-stage process. First of all, identify related party. Second is select the most appropriate method. And third is apply the arm length price. In the identification of related party, they have discussed in detail what is their example on this. While you are identify, how will you identify related party? How will you identify connected person? How will you go through the arrangements, and how will you identify the transaction? They have covered this in this section of the guide. Then the comparable uncontrolled price method. Then they discuss the method. The second stage, comparability analysis in the comparability transfer pricing method. In the transfer pricing method, they discuss 5 different transfer pricing method. In this internal comparable, external comparable, we'll discuss in the comparable analysis in our coming lecture. This is CUP method, comparable uncontrolled price method, resale price method. Transactional net margin method, as I mentioned, these are applicable where the highly integrated transaction, highly integrated operations. Every party knows what is the contribution, what are the risk they have taken, what are the function they have performed, whatever the assets they have utilized. Based upon this, they need to charge to the other party. There are 2 methods for this: transactional net margin method and profit split method. They have discussed these 2 methods in detail here. This is the profit split method. These are examples of the profit split method. Now choose the tested party, comparable uncontrolled transaction, internal comparable, external comparables, non-domestic. This is basically how will you ascertain the arm length price. Then they're discussing a transfer pricing documentation. We discussed the different types of form. One certain form, the entity needs to submit this form on an annual basis to the FT along with the return. This is the first thing, transfer pricing documentation, the general master file. This is a disclosure form. You can see here. This is a disclosure form. They need to submit on annual basis, master file, local file, CBCR reporting. Wherever this is applicable, every entity needs to maintain the documentation as well. The objective of transfer pricing documentation, the core objective of the documentation is to make sure in case the audit is being conducted by the FTA, the taxable person must have sufficient evidence to justify the transfer price arm length price. So this is the reason to maintain the documentation, and these documentation, as we discussed, is a form, master file, local file, and CBCR reporting. What is the criteria for this? Which business needs to maintain the master file? They have given the same thing here. The $3.5 billion if the entity is a part of the M&E group, or the revenue is 200 million, then they need to maintain the master file and local file. What is included in the master file, we have already discussed. What it is in the master file information, they have discussed the same thing in detail. Local file we have already discussed. Local file formation we have discussed. CBCR reporting, a certain criteria for the CBCR reporting. Every entity is not liable to CBCR reporting. They said the UAE CBCR requirement applicable to the UAE M&A group headquarters in the UAE with consolidated group revenue equal to or above 3.15 billion, around 750 million euros. This 750 million, it has been given almost the same number in the OECD guideline. They have taken the numbers from there. During the fiscal year immediately preceding the reporting financial year. So if the entity is part of the M&E group, and the group has a consolidated, the corporate office is in the UAE, the revenue is more than 3.15 billion, then CBCR reporting is compulsory. They need to maintain the documentation for related to the CBCR as well. Then specific consideration, as I mentioned, specific consideration, they have given the treasury function. In the treasury function, various things can be there. In this is a credit rating. This is implicit interest. The important thing about this is loans, cash pooling, all these hedging. They are doing, one entity is doing on behalf of the other entity, financial guarantee. One party is giving guarantee on behalf of other party. Then they need to maintain, apply the TP principles when charging to other party. Then in the same way, they have discussed intra-group services as well. Profit markup, intangible, because usually intangibles are developed at the central office, then they will be charging to other entities. They need to apply. Once intangibles are developed, if these are being recharged, we need to apply the TP principles. Business restructuring. We very honestly, we have so many things to discuss about the TP. So many things to discuss. Transfer pricing and risk assessment in case audit is conducted is the primary responsibility. Onus or burden of proof will be on the taxable person to prove that they have applied the transfer pricing rules and regulation properly, and the transaction has been charged on arm's length basis. They have discussed in this section 8. Then might be they will keep updating this guide. They have put it update and amendment. This is over. So if I'm going back to the basics that were discussed, what is TP? You all will be knowing what is the reason of application of TP. The TP is basically applicable. TP is applicable. Objective is basically prices should be on arm's length basis so that the profit will not be shifted from the high tax jurisdiction to the low tax jurisdiction, or from the high tax entity to the low tax entity. This is the objective behind the application of the TP, and this is applicable on the domestic transaction. This is applicable for the cross-border transactions. This is applicable when the transaction is being made with the related party. This is applicable when the transactions are being made with the connected person. Related party we have discussed, connected person we have discussed. And how can we ascertain the arm length price criteria they have given? We need to identify the parties. We need to do the comparability analysis. We need to apply the transfer pricing methods. We need to set the transfer price, arm length transfer price. So, and they have discussed the various transactions as well. This is over from my side. If you have any question, you can reach me at mahar@crestcooper.com. You can reach Faiza@crestcooper.com. Any other team member. We are always there to listen to you. We are always there to understand. We are always there to deliver. For any question, you can give us a call at 3391488. You can drop me an email at info@crestcooper.com. If you have any question, you are most welcome. Otherwise, we will keep discussing this subject. I think it will take a lot of webinars. We have so many things to discuss on the transfer pricing. If you have specific questions, you are most welcome. I know this, you will have many specific questions. And very honestly, we have very limited time to address all these questions. I suggest whenever we are discussing the specific topic, like we're discussing TP method, CUP method, RPM method, or cost plus method, transactional net margin method, or we are discussing the documentation, you can ask the relevant questions. So far as scope of the TP is concerned, on which businesses this is applicable, on which businesses this is not applicable, you are most welcome to ask the question related to specifically to this area. If you have any question, you are most welcome. Otherwise, as I mentioned, keep discussing the TP in our coming webinars. Thank you. This is over from my side. This is over from Faiza. You are most welcome if you have any question. No question? Okay, guys, take care and have a lovely day. Thank you very much. Thank you for being with us. Have a good day. Thank you. Bye-bye.
Thank you. Bye.